Now this lesson is all about gaps on a stock chart. And I'm sure you've seen them before. This is a gap, okay? AMD, Advanced Micro Devices Incorporated, closed at $4.60 about on this day. And at the open the next day, it opened right around $4. So that was a loss of 60 cents between the close on this day and the open on this day. And you may wonder, well, what might have caused that? And for a stock, not an indice, not an index like the Dow or the Nasdaq or the S&P 500, but for a stock, it's usually caused by one of two things. Now, I know by looking back at past headlines or PRs that this was news related on this gap down at the open this day. But this one was caused by earnings. So if you see a gap and you want to figure out why did it gap down so big? If you held 1,000 shares here at 460 and you were down at $4 at the open, you just lost $600 overnight. Okay, now this gap down was, like I mentioned, caused by earnings. And so you go back and you look at past PRs and you find out why AMD's shares plunged. And basically, you know, they beat the EPS estimate and the revenue, and you know the numbers were good, but their forward-looking guidance was not what the analysts were hoping for. It was much weaker going forward. Okay, so that's why the stock gapped down 60 cents at the open. Now this was purely news related. Okay, but okay, so you know, one of the things about if you're going to buy and hold a stock is that you have to read the headlines every day, at least 2 or 3 times a day. If you're going to buy and hold, you have to keep up with the most recent current events. Okay, and then you also, and most importantly, you know, stocks report quarterly earnings every 3 months and annual earnings once a year. So you have to know upon which date they are going to report earnings. In this case, the stock gapped up right here on good news, and then people pushed it up anticipating that earningswhispers.com said they were going to beat EPS guidance and revenue guidance and all that. But, you know, they couldn't tell you what the company was going to say about going forward. So it didn't meet analysts' expectations, so the stock fell. Now, years ago, I used to think it was fun to play gap plays. And as you can see here on Akamai, which is my favorite one, and I'll show you why here in a minute. This is my favorite stock to play the gaps. Okay, because it closed this day when it reported earnings after the bell at $36 and opened up just above $42. That's a difference of $6. On 1,000 shares, you made $6,000 overnight. And then it ran from 42 all the way up to just about 48. That was a good earnings report. Okay, but I finally realized that playing gaps on the earnings of a very volatile stock. Okay, now Akamai is extremely volatile every time it reports earnings. Let's take a look at a 2-year chart. As you can see, there are gaps all over the place. And these are all basically spaced 3 months apart on a regular schedule, and they're all earnings. Right here, he closed at $27.50, opened up at $32.50, a difference of $5. Okay, a few months later, this wasn't such a big gap, 35 to 37.50, you know, 2,500 up. But this one, he closed at around 42, opened up at about 34. You know, that's an $8,000 loss overnight if you held 1,000 shares through that. And this is the one I just spoke of from about 36 to 42. Okay, 6,500 overnight. Okay, but the bottom line is, even though I knew exactly when the earnings were, I had my after hours charts up, I had my pre-market charts up, Okay, and you can trade these during those times. But if you're not paying attention, or you have other things to do, and or you just don't know when the earnings is, you can either win huge or lose huge, and your odds are basically 50-50. So this is not technical trading. You're guessing. You can go to all the websites you know of, earningswhispers.com. You can go to Yahoo Finance and see what the analysts are predicting. And a lot of times they're very close, but they do not have any idea what the company is going to say about forward-looking guidance. And that's what happened to AMD. You know, they were above EPS and revenue expectations, but failed to meet analysts' expectations going forward. And that's why the big drop from $4.60 to $4. Okay, so playing the gap is dangerous, and I do not recommend doing it. On daily charts, buying and holding kind of a thing, hoping it's good earnings and good guidance. You know, you're just guessing, and you can lose thousands of dollars, hundreds or thousands or even tens of thousands of dollars overnight. And that is not technical trading. You might as well go to Vegas if you're going to want to play the stock market like that. Now, the other type of gap I would like to cover has to do with the indexes like the S&P 500, the Dow Jones Industrials Average, and the NASDAQ Composite Index. Now, you can't trade the S&P 500 because it's made up of 500 different companies, but you can trade the ETF like the SPY, which is the spider for the S&P 500. And as you can see, there are lots of gaps. Now, this was reporting season, and most companies, the majority of them, were posting good results. Good earnings, good forward-looking guidance. So the SPY gapped up just about every day. And you can trade the futures. The futures can be found on just about every major financial stock market website like CNBC.com, Bloomberg.com, Reuters.com, and they will all give you the futures. And what that means is the market closed yesterday, and then today it looks like a definite down open for the market. Okay, it could be news related. There are very, very many factors that can influence the futures, like earnings season is a prime example. News of the nation, world news has a big effect. Both of them can move the futures. And as you can see, this morning, the Dow Mini was set to open at fair value down about 46 points. The S&P 500 was down 5.52 points. The NASDAQ was down almost 20 points, and the Russell was down about 13 points. Okay, so that was news related today for the most part, because earnings season is basically over at this time. So the futures will tell you what is going to happen. Now right here we have a bearish head and shoulders chart pattern with a head here, the left shoulder here, and the right shoulder here, with neckline support right here. Okay, now the news was pretty bad in this area. It was all about Syria and the U.S. possibly going to war. And on this day, the market, it closed here the previous day and then opened here and went down for the next 3 or 4 or 5 days. Okay, so this was basically news related. Okay, and these are very tradable in the after hours, and then the pre-market session, the futures were going down. And you can trade the SPY, or you can just trade futures. I know people who only trade the futures. Okay, now that also applies to the Dow Jones Industrial Average. You're not going to see a lot of gaps here because the Dow Jones Industrial Average is made up of 30 of the best stocks on the American market. And you can't trade it. But you can trade an ETF like the Diamonds, which is the Spider ETF. Okay, and as you can see, it has many more gaps. let me go back to the Dow chart. Take a look at it. Okay, there's your head and shoulders again. And then go back to the diamonds. It's the exact same chart, but it has lots of gaps. Okay, and the Dow and the S&P 500 look almost identical, but the Nasdaq, because it is technology based, okay, is going to look a little bit different. See, there's your head, there's no left shoulder, there is a right shoulder, but this little peak right here doesn't show up on the Dow or the S&P 500 charts. And the tradable ETF for the Nasdaq, one of them is the Triple Q. Okay, that's the Power Shares ETF. Okay, and it also has lots of gaps, which are tradable in the after hours and pre-market session. Now this is lesson number 47 out of 50 in this beginner's guide to technical analysis. And after the 50th video, there will be a number of slightly more advanced videos that show you exactly how I trade. And there are 2 videos in this series of lessons that have to do with gaps. The first one is called the Gap and Trap, and the second one is called the Gap and Run. And here is a prime example of a gap and trap for FAS, the 3 times bull ETF for the financial sector. Now, you can't short this stock because it's not above $5, or it wasn't way back when. But you can short any stock that is above $5 on a gap and trap. But this is a perfect example. Okay, FAS closed right here. It opened the next day at the top of this big red candle and immediately, within the first 45 minutes, filled the gap. So it trapped. I call it the gap and trap because it trapped anybody that bought the high or the open thinking that it was looking strong. Now, most of the time, except for the gap and run, which is unusual circumstances, whenever you see a huge gap up at the open, and the higher price the stock, the bigger the gap will be. Okay, it almost all the time it will fill that gap. Okay, so it closed here, opened here, filled the gap before the first hour. This usually happens within the first half hour to hour of trading. Here it is again. FAS closed here, opened here at the high of the day, and within the first 45 minutes, actually the first half hour, had filled the gap, and then even went down further again to the lower Bollinger Band. Now, while the gap and trap is normal, there are exceptions to the rule. Like FAS again had some really good news this morning before the open, and it gapped up big. Okay, then it ran. It did not try to fill the gap immediately. Then it consolidated. The Bollinger Bands pinched and huge volume came in on the 5-minute chart. Okay, and the same thing happened with Citigroup because it is a member, or it is part of this particular ETF. So as you can see, accumulation, OBV, money flow, all up. Huge volume on the breakout. So it gapped up, it consolidated, Bollinger Bands pinched, huge volume came out, and it broke out to new highs. That's where you get in. Okay, that's very bullish.